Today, we're going to go through a topic that's on the mind of many of our investors and clients, and that is, where should you be buying within Brisbane under $800,000? And in today's session, we'll show you exactly how we would interpret the data, how we approach the data, and where we would recommend you focus your attention to, subject to the brief, which we'll be walking through shortly. Hey everyone, my name is Nick. I'm one of the directors here at Handle Properties. We're a boutique buyers agency with a strong focus on residential properties, helping clients execute transactions between $400,000 and $1.5 million. Both AJ and I are active investors ourselves. We've built portfolios more than $5 million each, all while working corporate jobs and on single income. At Handle Properties, we focus on the data, not the hype, but we also layer in the fundamentals and real-world experience to reduce the risk to help you make confident and smart investment decisions. So let's get started on how to find the best investment grade properties in Brisbane under $800,000. Now, before we dive into the data, let's define the brief of this search. And the brief is the underlying foundations of any property journey, because what you find to be an investment grade property for one brief may be completely different to another brief. So for the purposes of today's video, and probably most investors out there who are buying in this $800,000 budget, the budget is up to $800,000 plus costs. We are looking to invest with a need to extract equity within the next 5 years. So this is where, the property grows substantially enough that you can pull out your initial deposit and some more and reinvest the proceeds into another property. But also, we're in the game for a very long time. We're not looking to trade this particular asset. We're looking to hold it for at least the next 10 years. And most importantly, we have an operating budget of about $2,000 per month. So with that in mind, we're looking at growth corridors in Brisbane where the fundamentals are strengthening, and we're here to get that early gentrification or infrastructure cycle. We also want to understand the priorities of our search. Now, firstly, we want to be focusing on houses. Yes, houses are now starting to get a little bit more expensive in Brisbane, where quality homes are now selling more than that $800,000 mark. But there are still options sub $800,000, especially in that high $750,000 to $800,000 mark. However, if your budget is under $650,000, you should be focusing on townhouses and villas in these similar regions that we're putting up. But of course, look at incoming supply, because supply will always be the factor that reduces your long-term capital growth. And finally, we just stay clear of apartments, especially if your budget is under $650,000. Avoid apartments in Brisbane at all costs. So let's start with the first step, and that is layering HTAG, which is our go-to tool for finding suburbs that align with our brief. We'll build a search from scratch so you can follow the logic behind every step. For all of those who don't know, HTAG is a data analytical software that covers every single suburb in the country and allows you to build filters to find areas that are of interest to you. So let's start off with the filters that we have put into our particular search. We want the price to be under $800,000. Typically more than $550,000. Again, this weeds out some of the really low quality assets in Brisbane. We want the confidence of the data to be high. Now, this is a metric that runs in the back end to make sure that we are looking at suburbs where there is enough sales and activity over the last periods so that the data points behind it are pretty confident. And importantly, we also want to be looking at the affordability index. So this is where we're looking for how long it takes for the average household income in a particular suburb to pay off the average home in that suburb. So typically, if it is under 40 years, it's, a relatively affordable place to be. But in some parts of Brisbane, you will see that, there are areas where the affordability goes beyond 40 years. And of course, that's incredibly challenging when you say to a particular homeowner in that area that you're going to be spending more than 40 years of your life to pay off that home. Now remember, more affordability, so let's say the number is closer to 25 or 30, it means people in that area are making very good income relative to the houses in that area, so they can afford to either upgrade, renovate, and make sure that the values in their homes keep increasing. The next filter we want to layer on is called the URSAD, for the full abbreviation. So this is the Index of Relative Socioeconomic Advantage and Disadvantage published by the ABS. So an URSAD less than 2 typically 1 or 2, you're looking at very low socioeconomic areas. So thinking about, your areas that historically might have been more closer to housing commission, less access to transport, less access to amenities, all of those things come into play. So we're looking for areas where the ersatz is actually higher. So where the residents in that area have good socioeconomic advantage, whether it be access to amenities, good incomes, good affordability, and whatnot. So this is a really good index to look for. We also want to look for areas where the stock on market percentage is less than 3%. So that basically means less than 3% of all stock in that particular suburb is currently available for sale. Now, this broadly is a healthy and balanced market, but there are areas across Brisbane that are much less than 3%, and also areas where there's much more than 3%. And typically those areas that are much more than 3% are those new areas where there's lots of new supply coming on the market, or there's a reason for you not to live there, or it might be a place where you do not want to live because, for example, in Brisbane, there might be huge amounts of flood affected areas, especially near the river. So people are selling out, and that's going to increase that stock on market percentage. We also want to look at the building approvals ratio. So this is, again, a function of showing what is the incoming supply into that area. Now, again, we want this to be less than 3%. We want a balanced ratio of new supply coming in, whether it be new land releases and, of course, new homes coming into the area, but also from a function of increased density, where you might have larger homes that are being converted into townhouses, or larger blocks that have been converted into medium and high-rise apartments. So again, looking for an area that's less than 3%, especially in Brisbane, you're going to weed out those areas where those big apartment blocks are coming in. Because again, supply is going to be a detriment to your long-term capital growth. And finally, we're looking for areas where people traditionally hold their home for greater than 7 years. So again, these are owner-occupiers typically who will come into an area, live in that area, and they want to live there for a long time. So they're not investors, they're not those that are trading out their assets within 3 to 5 years. So you've got long-term stability in the home ownership in that area. So putting all of these filters into play, you can see here only 5 suburbs come up in the greater Brisbane area that fit the brief here. So you have Collingwood Park, Flinders Hill, North Ipswich, Waterford, and Yamanto. And going through where these places are broadly, the top 3 are in Ipswich, and you have 1 in Logan. So let's go through the specifics of that particular area. So starting off with Yamanto, Yamanto is based in the Ipswich area on the southern part, well away from the river, very little flood risk out here. You've got average home prices about $786,000. Your average yield is about 3.55%. Again, very, very common for Brisbane as a whole. Over the last 10 years, this area has done phenomenally well. It's gone up about 130%. In the last 1 year, it's gone up about 11% as well in capital growth. And furthermore, you can see here rents have gone up about 60% over the last 10 years, and it continues to go up in the last 1 year as well, up 5%. So the growth rate in this particular area has obviously been high. So right now, it's pretty obvious that you're buying into the peak of the cycle, and it's probably going to be that this particular area will continue to provide those positive returns. But, last year, that capital growth was 11%, and over the last 3 years, 44%. So it may not be as high, and you might be looking at closer to sort of 5, 7s, and 10% in capital growth in the next 12 months in this Yamanto area. But again, that's not to say that you're going to get negative growth. It just means the coming few years are not going to be as strong as the previous years. And you can see here the ersatz is 4. So again, really, really high on the socioeconomic advantage score. Only 31% renters, a great stat to look at. There's a lot more owner-occupiers in this area. Stock on market, incredibly low. Only 4 listings, so under 1% stock on market. Building approvals, only 3 new homes coming on in this area. People are holding properties in Yamanto for, almost 10 years. Again, all these metrics are really strong metrics to show that this is a great suburb to invest in today. And most importantly, inventory levels decreasing over the long term and the short term, stock on market in decreasing over the long term and the short term, and building approvals starting to come down as well. Again, all really good metrics. Similarly, let's go to another part of Brisbane that has come up, which is Waterford, which is in the Logan area. So in Waterford, we are looking at an average purchase price of about $750,000. The rents are much more stronger, closer to 4%. Waterford is on the south of Brisbane. Over the last 10 years, this area has done 120%. It's done 12% over the last 12 months and 36% over the last 3 years. So an incredibly strong performer, as has a lot of Brisbane. And rents, they've gone up about 50% over the last 10 years. They've gone about 33% over the last 3 years and only about 4% over the last 1 year. So again, on its way down. But the growth rate cycle, very similar to Yamanto, it's done phenomenally well since 2020. It is definitely on its way down, but it's still going to be providing those positive returns. So again, if you want to be buying into an area that provides that long-term stability, so again, you're going to be holding an asset for the next 10 years or more, but you want to extract out that equity in the next 3 to 5 years, this is a great place to be buying. And back to the fundamentals, the ersat is again 3. So again, it's not low socioeconomic, it's not high socioeconomic either, but it's very much a balance, which is relative of the price that you're paying for this particular suburb. 40% renters to owners, a little bit high, but not the worst. But then again, these metrics of supply are just fantastic. Stock on market, less than 1%. Building approvals, only 6 building approvals. People are holding assets here for more than 7 years. And looking at the charts, you can see here, over the long term, stock on market is the inventories continuing to decrease, and the building approvals are just getting closer and closer to zero. It's an incredibly tight market. People want to live here and there's just no new stock to come on in. So what does that mean? Prices are going up. So going back to layering HTAG, we've done that. We've put in our core filters and we can now see a handful of suburbs that are coming up that are of interest based on our core filters. The next thing that we want to do is layer on the fundamentals. And there are 3 fundamental layers that we want to be putting into our analysis. So that is infrastructure spend. We want to be following where government is spending their money. Because where government spend their money, that means there's going to be more jobs during that, spending phase, but also whatever they build, that's going to provide another economic boost to that particular area. So government spending, super important. But also government spending is usually accompanied by lots of private spending. Again, these are all factors to increase jobs and demand in that area and why people want to live there as well. The next thing we want to look at is gross regional product. So similar to GDP, which is the gross domestic product of our country, gross regional product is for that particular area. And I want to bring up some stats to make sure that we're buying into an area where GRPs continue to go up. And finally, we want to be looking for value for money. We don't want all of these stats to be coming in, but then what you're buying is a crumbling down piece of crap house. You want to be able to buy quality homes in these areas subject to all of these metrics. So let's start with the infrastructure spend. So the first one is for that Yamanto region, which is towards the west, towards Ipswich. What we like about this area is that there is a massive Ipswich Hospital expansion project coming in. So it's a pretty large project worth about $710 million with 200 new beds coming to that Ipswich area. Again, it's just a metric to rely upon to say that the government cares about this area and they're investing in the people that live in this area. But also think about what will happen when a 200 new bed hospital or expansion of that hospital comes into place. You've got nurses, you've got doctors, you've got medical technicians, you've got all the medical adjacent industries such as suppliers of medical products and whatnot, all needing to have workers in that area, all needing to have businesses and footprint in that area. So it really is a powerhouse of ongoing demand for housing in that particular area when we have projects like this happen. So again, this is purely to say that there are great suburbs to invest in, but if you can make sure that you're aligning it with an infrastructure project, that gives you the confidence that the government cares to continue to invest in this particular area. The next part of that is the gross regional product. So for Ipswich as a whole, which is where Yamanto is located, that entire area provides a GRP of about $15 billion, which is pretty big. And on a per capita basis, there's about 230,000 people that live in that Ipswich area. We're looking at a per worker GRP of $192,000. So again, pretty strong, where each worker provides at least almost $200,000 in GRP or value for the work that they provide. And furthermore, you can see where all that GRP is coming from. You've got a strong manufacturing sector, public administration, construction, real estate services. Again, super diversified. We're not skewed to a cyclical or, one mining or one agricultural type sector. You're looking at long-term stability by having a wide range of sectors that are providing support to the GRP of this particular region. So the next one is for Waterford. So we wanted to see, the first one is also a hospital expansion project that is happening in the Logan area. So you can kind of see here, we have 206 beds coming through, and it's an overall a $1.1 billion contribution to this particular area. Again, we want to be following the money. Similarly, in Logan, we have a massive upgrade, basically connecting Brisbane all the way down to Gold Coast through the upgrade of the motorway in that area. So again, we're looking at a total $1 billion project that's going to be going from 24-25 all the way to 2028. So $500 million between the Aussie government and the Queensland government. Again, all tick marks that we are following the money in this particular area. Finally, we are looking for the GRP of Logan. Again, super strong. We have GRP of about $19 billion. But more importantly, what is the GRP per worker? We have 345,000 people living in the area. But per worker, we're looking at almost $200,000 in GRP. So again, a super strong area to be investing in. So now we've done the fundamental overlays. Now let's see what properties have recently been sold in this area. So I've already brought them up for you, but feel free to go and have a look in Yamanto and in Waterford that's recently been sold. So you can see here in Waterford, sold on 14th of May, just a couple of months ago, 19 Jasmina Parade. Again, a typical type of property that we would love to buy. A 4-bedroom, 2-bathroom home on a nice, decent block. Again, very rentable, lots of owner-occupier appeal, which will be great on the exit because owner-occupiers are the ones that pay good money when you want to sell. Very presentable home over here, as you can see here. Sold for $760,000. So again, well under $800,000 to buy. Similarly, in Yamanto, there's this property here on a much larger 750 square meter block, also 4-bedroom home and in good nick as well. So it's going to bring this up for everyone to see. Again, good owner-occupier appeal, easily rentable, and it's important to have owner-occupier appeal because when you go to sell, they are the people that are going to be paying you that extra money to be buying into a beautiful home because owner-occupiers drive up housing prices. So as an example, let's do the numbers for 19 Jasmina Parade in Waterford. I've already done them over here. So we're looking at a $760,000 purchase with a 20% deposit, land value of about $600,000, and the rent per week for this property, here we go, is appraised between $590 and $650, around that $620 to $650 mark. So I put it in at $650 after all costs. That should be $5,000. This property will cost you about $200,000 out of pocket, about $33,000 in gross rental income after all costs. So property management, water rates, council rates, general repairs and insurance, and mortgage interest at 6.5%. You're looking at $51,000 in total expenses. Your net rental income of $17,000 a year, some depreciation benefits, a tax refund. This property on an interest-only loan is well under the budget of $2,000 a month. This is going to cost you about $1,400 a month on a pre-tax basis. And after your tax refund, it's only going to cost you $681 a month to own this property. And if this property grows by 10% in the next year, that is an extra $76,000 worth of capital return, all for $681 a month. Now, that is a pretty good trade-off if you ask me. So there you have it. This is how you find high-quality investment properties in Brisbane under $800,000 using a data-driven and fundamentals-first approach. We started off with filtering the market with HTAG, overlaid our infrastructure and demographic fundamentals, and then found property examples and tested their cash flow against the brief. So if you're serious about buying in Brisbane or anywhere in Australia and want help sourcing, assessing, or negotiating the right property, we'd love to help. Hit subscribe, like the video, and feel free to reach out if you'd like a copy of our spreadsheet or if you'd like to book in a strategy session. Thanks for watching, and I'll see you in the next video.